Okay, so the first thing I want to talk about is the second assignment. Don't panic. It isn't due until the end of class. It's due 3 Wednesdays from now, I think. And I'll have a write-up in Canvas as well, um, to put all of what I'm going to say into writing. However, I just wanted to tip you off if you wanted to get a head start on it. Um, it's going to be another write-up. Um, no more than 1 to 2 pages, but I want at least 1 page. It can be a qualitative or quantitative analysis. So if you want to use your words, that's fine. If you want to use your math, be sure to walk me through. You don't have to show me all your work, obviously, because it's a paper, but just walk me through how you came to the numbers that you got. So what you're going to be doing is analyzing some financial statements. This whole term, we've been talking about different types of accounts, and we've learned a few analysis tools to compare different accounts, like debt to equity ratio and things like that. So what I'm going to have you do, let me share my screen real quick. Okay, can you guys see my screen okay? First, let me move this out of the way. So I'm going to want you to go to the Securities and Exchange Commission website, okay? If you put in Securities and Exchange Commission, like I did right up here in my search engine, your first hit will be the sec.gov. You want to go to Edgar. That is their financial statement lookup. Then put in any company you want to know more about. If you want to look for Target or Walmart or, you know, uh, Nike or anything, I mean, Toyota, anything, any company that operates through the SEC, that means that they're a publicly traded company. You can plug in a few to see what they've got available. The important thing, I'm going to look up Disney because I'm that kind of person. I'm that guy. Okay, so they have a lot of different filings. They'll have a ton of stuff here. You want to keep scrolling down until you find their annual report. Okay, that's what you're looking for. They have a ton of, yes, in the front yard. Um, So right here, the 10K annual report, that's what you're looking for, okay? It'll either say 10K or annual report. When you click on that, um, a lot of times they've got a bunch of things that they want to tell you about in their annual report. Remember back when I first talked about financial statements that outside of the financial statements, they can put all kinds of other information in there. There can be notes, they can be management's discussion and analysis. For Disney, their financial statements start on page 73. They like to crap on at great length. Okay. Or I think it actually starts on 72. Right. Yep. So sometimes companies call their financial statements by names that you may not be used to. In this case, instead of just calling it the income statement, they call it the consolidated statements of income. You guys, I mean, it's Hmm. It's not, it won't be that obscure, okay, but it may not say income statement, balance sheet, and statement of cash flows. Um, so from here, you could make a qualitative analysis. You could discuss how they provide comparative financial statements and their revenues seem to come primarily from services rather than from products. You could do a year-over-year analysis and say, you know, in 2024, now I'm making this number up because I haven't crunched the numbers on this, but in 2024, they made 15% more in service revenue than in 2023. I did notice when I was going through this, when they calculated their depreciation, it is about the same for 2023 and 2025. What happened in 2024? Who knows? There's no way to drill down and find out. But these are all qualitative assessments. Um, Let me just let these guys in real quick. Okay. So a quantitative assessment would be to do a debt to equity ratio or a um, assessment of their current ratio. All of these we've talked about up to this point. We're doing another analysis tool tonight. I don't remember which one that one is, but you can use any of those. Does anybody have any questions on this assignment? Again, I just wanted to walk you through how to use the SEC website before I put the write-up online. Okay, hearing no questions, I assume that all is well. Again, I will have a more formal write-up on that in the coming days. Okay, so tonight we're going to talk about current liabilities. A lot of this is going to be review. We've talked some about liabilities already. And we're going to talk a little bit about payroll and how we accrue that. But a lot of this should be review for you guys, okay? That said, I'm not shaming anyone. If you have questions, please let me know as we're going along, okay? So, just to recap, remember that liabilities are things that you owe, okay? They occur as a result of past transactions. Okay, and they're going to create this obligation that sits on our books that we need to pay in the future. Okay, and they're not an avoidable obligation. Okay, this is something that debt that you have already incurred. Okay, so they come in two flavors, current liabilities and long-term liabilities. Um, the current liabilities have to be paid within the period. So that's 1 year or their accounting cycle, whichever that is. And then long-term liabilities, of course, extend into multiple different accounting periods. Okay. All right. So some examples of both of these, we've got on the current liability side, we have accounts payable. We have our sales tax payable. We're going to look at the way to record that tonight. And unearned revenue, we've seen that already in other chapters. Okay. That's when somebody's paying us in advance and we haven't provided that good or service yet. Okay. On the other side, we have our long-term liabilities. That's our notes payable. We've looked at that already, mortgages and bonds. Okay, So sales tax. When a company charges you sales tax, of course, that's not money revenue for them, right? That's a liability. They're taking that money from you and they're holding it to give it to the government at some later date. All right. So as an example, wherever Smart Touch Learning is located, their sales tax is 6%. They made a sale of $10,000. So they will receive cash of $10,600. Only 10,000 of that is revenue. The other 600 is sales tax payable, which is a liability. Okay. When that tax bill comes due for that sales tax, the journal entry will look like this. You know, sales tax payable is just like buying something on account. It looks exactly the same, right? So you are going to zero out that that liability. And then you're also going to reduce cash by $600 because you took that cash and gave it to the government. Okay. All right. So income tax, again, that's a liability. It sits on their books until it accrues on their books until they're ready to pay it. So at December 31st, they have tax expense of 3,780, income tax payable of 3,780. Then when they go to pay it on March 15th, remember, corporations, their tax date is a month before individual taxpayers. They are going to zero out that payable that you created, and they're going to reduce cash. All right, unearned revenue. I'm not going to spend a ton of time on this because we did this weeks and weeks ago. Okay. Okay, so short-term notes payable. We also covered this. This is where you sign a promissory note stating that you will pay back an amount with interest. Unlike a loan, you're going to pay, instead of making payments on it, you're going to pay it in a lump sum with that interest tacked on. Okay. So you purchased inventory with a note payable. You're going to increase your inventory, but also increase this liability. Then when it comes due, that interest, remember, the interest rate is always annual. Okay. So we multiply the principal times the interest rate times the number of months that it was outstanding. So we only had this loan for or 90 days, the number of days that are outstanding. So we only had this loan for 90 of 365 days. Okay. And then we reduce our cash by this amount. Okay. You will also borrow money from banks in the form of a loan. You will also have to sign a promissory note for that. And again, you will also pay principal plus interest. In this case, it's going to be a note payable. Unlike a loan, you pay it in a lump sum with the interest. Okay. But it's the same. You're just receiving cash instead of that inventory that you got in the last transaction. Okay. But it's the same journal entry. It's just cash instead of inventory. All right. So when you have a long-term note payable, they are usually going to be reported in the long-term liability section. Okay. It is general. Now we're talking about your traditional loan. Okay. That's paid in installments. Okay. you're going to expense that installment payment and report, well, before you expense the installment portion, you're going to have it on your books as a current liability because that's what you're going to pay in this year. Okay. And all the rest of that loan is in long-term liabilities. Okay. All right. So on to payroll. All right. So, um, payroll as it accrues as a liability, and I think I might have discussed this previously because um, you, as an employee, you work on Monday and you earn 8 hours worth of salary. Then you work on Tuesday and you earn another 8 hours, and then Wednesday, but they're not going to pay you until Friday, right? So for all of those days that you're earning money, but you haven't gotten that paycheck yet, your um, uncompensated services are a liability on their books. Okay. Um, for service organizations, this is going to be their primary expense. All right. Um, different words that we use to talk about pay for employees. We have salary. I've been using that word, throwing that word around quite a bit. Though usually, salary, when we talk about salary in our normal day to day, we're talking about a fixed amount rather than an hourly amount. Okay, we can call it compensation. Employees can earn a commission as a percent, often sales uh, personnel earn a commission that's a portion of their sales, a percentage. You can get bonuses. Your benefits that you receive at work are also considered pay. They're a type of compensation. Okay, so how do we record this on our books? So in this example, we've got Ryan. He was hired to work at Smart Touch Learning. He gets $15 per hour. That's straight time for 40 hours. Okay, the company pays time and a half for overtime. So he gets 22.50 when he goes over into overtime. So if he works a 42-hour week, his gross pay is going to be straight time at 40 hours for 600, and overtime is going to be 2 times 22.50, $45. So his gross pay is $645. So when we're accounting, we have to be aware of this thing called gross pay and this other thing called net pay. Okay. Gross pay is the entire amount that the employee earned. Okay. But the net pay is what that employee gets to keep after taxes and withholding and all of those things. You guys probably already know this, but I just want to make sure that those two terms are clear. Okay. So there are some payroll deductions that you might see taken out of employee paychecks. We have to take federal and state income tax, right? Death and taxes are the only two things that are certain in this world. We have to take out Social Security tax, and then there may be other deductions that are required if there are, delinquent tax payments or spousal or child support due, things like that. Okay. And then there are optional deductions. Okay. Things that we choose to have taken out of our monthly pay. So we have insurance premiums, retirement plan, 401k, things like that, and charitable contributions. Okay. So The amount of money that is held back from your paycheck to cover income tax is called withholding or income tax withholding. Okay, and that is based on the amount of gross pay and the number of withholding allowances that you have claimed. Okay, so for example, and if anybody's filled out the I-9 when you start a new job and they have you bring two forms of ID, you've done this before. An unmarried taxpayer only has one allowance. They generally pay a higher rate of tax than somebody who's married with five children, for example. Okay, this is an example of a W-4 form. This is the withholding allowance certificate. Okay. And then FICA is your Social Security tax. Okay, it's the law that employers have to withhold Social Security tax from all employee paychecks, even though none of us are going to get Social Security when we retire, right? There are two components to FICA. There's OASDI, which is Old Age Survivors and Disability Insurance. That is your Social Security payments after retirement, and then Medicare, which is medical benefits for retirees. Okay, so here's an example. Assume that James Colon, another employee of Smart Touch Learning, earned $142,700 prior to December. Colin's salary for December is $10,000, and Colin's FICA tax withheld from his paycheck is going to be calculated as follows. So he has $147,000 that are subject to tax. Okay, he's had 142,700. That's from up just this information right up here for the current month. All right. So his current pay, so the pay for this month that's subject to taxation is 4,300 at a tax rate of 0.062. So $267 are withheld from his paycheck. This is just for OASD, okay? And then we're also going to calculate Medicare, okay? The full $10,000 is subject to Medicare tax. That tax rate is 0.0145. So for Medicare, he's got 145. So his total FICA withheld is going to be these two items. So you usually see this broken out on your pay stub. Not OASDI versus Medicare, but your FICA withheld. Okay. So some companies are going to take out those deductions and then pay them to specific organizations. Okay, so for example, some companies have more than one insurance plan that you can join. In which case your employer withholds that insurance payment from your check and then provides it to the insurance company in one lump sum with all the other employees, okay, that are part of that plan. They do the same thing with retirement savings. For example, 401k is an investment portfolio that's opened on your behalf, and the employer just takes the money out of your paycheck, sends it over to the investment company, and they invest those funds for you. Okay. Other examples would be like union dues and charitable contributions. I don't know if any of you guys have ever worked for the government, but you know how they have that big charitable drive every year, and that it's an elective withholding. So employees can say, okay, well, I'd like $10 of every paycheck to go to the SPCA or to go to the Wounded Warriors program or, whatever. And then your employer takes care of that for you. Okay. So here's an example of calculating optional withdrawals. Here's James Cullen again. His final pay period on December 31st assumes that he authorized a $180 payment for health insurance and a $20 contribution to United Way. So employee income tax is assumed to be 20% of gross pay. So here's his gross pay. He's got $10,000. His income tax is going to be 20% of that. So that's 2,000. We calculated OASDI and Medicare already on a previous slide. So we're going to take those out. Then his employee health insurance of $180 and his contribution to United Way. So of his $10,000 that he earned, he gets to keep $7,388. Yay. So lots of companies have these payroll registers. This is part of the underlying supporting documentation for payroll, in addition to your pay stubs that you have on your end to prove, if you're ever audited by the IRS, to prove that these are your actual earnings. On the flip side of that, companies have these payroll registers to show what they've paid out to their various employees. Okay, so you can see all of their staff are listed here. They've got their cumulative earnings. That's what they've earned throughout the year. Their earnings this period, this last period, and then their total, and then all of those withholdings for each person. How much they were paid, their net pay was, and what that check number was. Okay. So we can't get through any part of any new accounting principle without looking at how to make it into a journal entry. All right. So when December 31st comes around, we've got this salaries and wages expense. Let's go back. Oops. So our total payroll is 28,580, right? From our little table here. So in total, that's our salaries and wages expense. And then we also have all of these liabilities that we have to record: taxes payable, Medicare taxes payable, employee income taxes payable, United Way, salaries and wages, etc. Okay. So then on payday, Smart Touch Learning makes a payment of $19,727 to its employees and records the following. So that payable that we talked about here, salaries and wages payable, 19,727. Then this is where we actually pay it off. Okay, so our salaries and wages payable, we can zero out that liability because we're paying our people now, and we reduce our cash. Okay. Now, employers have to pay 3 different payroll taxes, okay, that are not withheld from the employees. This is coming out of the employer's pocket. All right. So they take that money out of your paycheck to give to the government, and then they have to also put into that pot as well. So employers have to pay a FICA tax, both OASDI and Medicare for each employee. They have to pay into state unemployment compensation tax and federal unemployment compensation tax, okay? So SUTA and FUTA, so the state unemployment and federal unemployment, um, taxes are paid by the employers to the government. Okay, and then the government holds that and pays that to those benefits to people who are out of work. All right. So employer payroll taxes. Um, this table right here is going to show you the distribution for an employee that earns $1,000. Um, so this is the employee's net pay withholdings, and then over here are the employer's taxes that they have to pay on this. Okay, so you can see they've got OASDI, Medicare, FUTA, and SUTA, and the percentages that they have to pay on each of those. Where do these numbers come from, you might ask? Um, it is updated regularly. This is from the government question. Okay. You can look, there are tables that you can use to look up what the current withholding is for Medicare, um, old age benefits, and unemployment. Okay, so this table is showing payroll taxes for the entire payroll, so all of their employees. Their portion over here of their OA, SDI, Medicare, FUTA, SUTA, they owe a total of $2,073 in taxes. So, when you record the payroll tax, you're going to record a debit to the tax expense and a credit to all the payable accounts. Okay, because you owe this these FICA expenses and these unemployment taxes. Okay. And then when you pay those, it's just a liability. We think that tax is very complicated and fancy, but in reality, when we go to pay that tax, we've calculated all the taxes, all the different types of tax that we owe. We're just zeroing out all those payable accounts and taking that big lump sum out of cash to show that we've paid them. Okay. So, internal controls. Let's put our auditor hats on. Okay. Payroll tends to be automated for efficiency purposes, but there are different controls we can use to safeguard payroll and make sure that we are paying the right people the right amount. We can have employees sign for their checks. We should keep hiring and firing of employees as a separate function from payroll within the HR. Because what we don't want is to have ghost employees. That's when an employee is no longer working for the company, but you're still cutting checks under that name and they're going to somebody who works in HR. Okay. Because they are responsible for, they know who's being fired and they're also responsible for filling out those checks. All right. So time clocks and direct deposit is another method that people use to take the human element out of the payroll process. Okay. So sometimes there are estimates involved with these current liabilities. Okay. So you know that you have a liability, but you're not sure how much you're going to pay out. So you're going to have to estimate it and report it on the balance sheet. So that could be bonuses. You don't know how much you're going to be paying out at the end of the year, or vacation pay. The employees are accruing this vacation time, but you don't necessarily know how many employees are going to use it in any given year. Also, health and pension expense benefits and warranties. Okay, so for bonus plans, we'll hit that first. So in this example, we're going to estimate that it's going to pay a 5% bonus on annual net income after deducting the bonus. The company reports net income of 315,000 before calculation of the bonus. Okay, so we're going to calculate that as the bonus percent times net income before the bonus. That's this. Okay, divided by 1 plus the bonus percent. Okay, so that's going to be 5% of 315,000 divided by 1.05 is going to be 15,000. Okay. All right. And then the way we record that as a financial, as a journal entry, okay, is as an expense of 15,000, and then we have this payable of 15,000. And then when we go to pay it, remember we're going to zero out that payable and deduct that amount from cash. Okay, so vacation, health, pension benefits, all that stuff. Again, you're using an estimate because you don't know how much of this you're going to be paying out. So you have experts in figuring out what you are likely to pay out for the year, and you're going to record that as a liability on your books. Warranties. So a lot of companies are going to guarantee their product against any sort of defects using warranty agreements. And the time period of the warranty is going to vary depending on what kind of product it is and the company's policies. Okay. But we want to match the warranty expense with the same period that the company records the revenue. Okay. So when you're selling the item, that's when you want to record the warranty expense, but you don't know how many of those items are going to be returned. So we've got to kind of create this estimate. Okay. So Smart Touch Learning made sales on account of $50,000. Okay. Cost of the merchandise, the cost of goods sold is 35,000. The product warranties on June 10th, there's an estimate out there that the warranty cost will be 3% of sales. Okay. So on June 10th, accounts receivable, you're going to get $50,000 and $50,000 in sales revenue. Now you're going to want to mark down your inventory. So your cost of goods sold here, and your merchandise inventory is going to go down, and you've got to recognize this expense, your inventory expense. Then the warranty expense is going to be 3% of this 50,000. So you will expense that, and then you're going to have your payable on the books, this liability, just in case someone wants to return this item, of 1,500. Okay, so some of the customers that they sold these items to claim that warranty. Okay. So they have $800 in claims on June 27th. So then we're going to write down the payable by $800 because 800 of that 1,500 we've paid out now. And then our merchandise inventory goes down by 800. Okay, because we're replacing the item that they returned to us. So we got to put out another $800 worth of inventory. Okay, so contingent liabilities. These are super fun in the accounting world. This is a liability that you might have based on a future event. Usually has to do with people being sued. Um, any large corporation that you could possibly think of is probably being sued by multiple people at any given time. Okay, so they need to have this on their books to let people know, hey, I might have a payable someday that's quite large, but we don't know if it's going to happen and how large it will be. Okay, so um, like I said, it's a crazy world we live in, but so these contingent liabilities fall into three categories, and we report them differently depending on which of these categories they fall into. Okay, so it could be a remote possibility. It's very, very unlikely that they're going to have this liability on their books. It could be reasonably probable that's it's likely to happen, or probable, which is, yeah, they're probably going to have to pay up. Okay. So here is a table that shows you what to do with them in the financial statements, depending on what the likelihood of this lawsuit being successful. Okay. So if it's remote, you don't have to disclose it. Okay. If it's reasonably possible, then it goes into the notes. Hey, somebody might be suing us and we might have to pay out this money. All right. If it's probable and the amount of the expense can't be estimated, then you describe the situation in the notes. If it's probable and the expense can be estimated, then you have to record an expense or a loss and a liability based on the estimation of those amounts. How do you know whether you're likely to lose this lawsuit and how much you're likely to owe? Your lawyer tells you that. And they send a letter to your auditor that says, these are all the people who are suing them. Only two of them are likely to be collected on, and each of them is going to be about $1 billion. It'll look like that. Okay, so now we get to our ratio. Tonight's ratio is going to be the times interest earned ratio. Okay. This is how you figure out how capable a business is to in paying off its interest expense. Okay. Um, it's also called the interest coverage ratio. All right, banks use this frequently. Okay. A high interest coverage ratio indicates that a business can easily pay any upcoming interest expenses. Okay. So this formula is um, times interest earned ratio is equal to net income plus income tax expense plus interest expense. So, for example, these are taken from PepsiCo's income statements for 2021 and 2020. We have their net income, their tax expense, and their interest expense. Um, so we've got their 2021 net income, income tax expense, and interest expense divided by just the interest expense. Okay. that was cut off. That's why I was flipping back and forth because I was like, wait a minute. Um, they didn't show that it's divided by the interest expense. Sorry about that. Um, and then for 2026, you've got income, taxes, and interest expense divided by interest expense. So in 2020, they had a times interest earned of 8.99. So it was higher in 2020 than in 2021. Okay. That is it for tonight's lecture. I can't believe that I got through everything I needed to cover. This is great. Are there any questions about anything that I covered tonight?
No,
Okay.
I don't think so.
All right. Hearing none, um, then that's all.